pull up a chair and sit down right here on the porch, because there is no sense in rushing around like a headless chicken when the sun is shining so beautifully over Omaha today. Here, take this cherry Coke and let the cold and cool off your hands, while we talk about something that seems to have the folks on Wall Street running around with their hair on fire. I was looking at these papers you brought me about the bond market, and it reminds me of what my partner, Charlie, always used to say about how humans have an unlimited capacity to make simple things complicated. The data shows that trades, specifically those involving the most recently issued 10-year note that failed to settle on schedule, totaled $30.5 billion during the week, ended December 10th. Now, that is a big number, even for a guy who has been around as long as I have. And it turns out it is the most we have seen since way back in December 2017, at least according to the recent data from the New York Fed. When you see settlement fails spiking like that, it usually means that too many people are trying to squeeze through a very small door at the same time. And they are forgetting that the market can remain irrational longer than they can remain solvent. It is just another example of the short-term madness that grips the financial world, where people are more concerned with the plumbing of the system rather than the quality of the water flowing through it. It really gets interesting. You know, when you look at the peculiar conditions that allowed this mess to happen, because it defies the common sense that you and I learned in grade school. These fails occurred right in the middle of a collapse in interest rates available to the owners of the newest 10-year note, which was created via a $42 billion auction on November 12th. It has gotten so crazy, honestly, that holders willing to lend the note were able to do so at negative interest rates, with borrowers agreeing to sell it back the next day for less than they paid. Just think about that for a second, because it is the financial equivalent of paying someone to borrow your lawnmower and being happy when they return it with less gas in the tank. This is a circumstance in which settlement failures are quite naturally much more likely to occur because the incentives are all out of whack. While it is not unusual for Treasury securities to command special rates in repurchase agreements ahead of a reopening auction, the shortage ahead of the 10-year note reopening that settled on December 15th was, without a doubt, out of the ordinary. It shows you that when people start playing games with leverage and repo rates, they often lose sight of reality, and they end up tripping over their own shoelaces in a race to pick up pennies. The root cause of this scramble, if you look closely, is actually a lesson in supply and demand that is as old as the hills. But somehow, it always surprises the sophisticated crowd in New York. The shortage stemmed in part from the smaller portion of the November auction, relative to the 10-year notes sold earlier in the year, owned by the Federal Reserve, which makes its securities available to borrow. As Jason Shute, the president of South Street Securities, aptly put it, there's just less available to borrow. He pointed out that for this particular 10-year note, the Fed bought half of what it did in the previous 3 cycles. And that caused a supply shortage, which inevitably leads to delivery fails. In that November auction, $42 billion was sold to investors. And the Fed requested an additional $6.5 billion for its account to replace maturing debt. Now, compare that $6.5 billion to the previous quarterly auctions, where the Fed's add-ons to the same $42 billion private market totals were $11.5 billion in February, $14.8 billion in May, and $14.3 billion in August. When the biggest buyer in town suddenly decides to buy less, the store shelves look a lot different. And the people who were counting on that liquidity find themselves swimming naked when the tide goes out. Now, we have to dig a little deeper into the plumbing to understand why the Fed pulled back, because it involves the kind of technical details that make most people's eyes glaze over. Those amounts, you see, are a function of the quantity of Treasury securities that mature from the Fed's system open market account holdings, which totaled just under $22 billion for November 15th, compared with amounts ranging from $45 billion to $49 billion for the previous months of February. May and August, the drop-off in the amount of SOMA holdings occurred because back in mid-2022, the Fed began reinvesting its maturing treasuries only to the extent that they exceeded a monthly cap. This cap, mind you, actually increased to $60 billion a month in September, up from $30 billion a month in June. As a result of this mechanical adjustment, the Fed's add-on in November to the auction of 3-year notes that matured this year declined relative to previous quarters, requiring smaller add-ons to last month's auctions. It is a complex machine with a lot of moving parts. But the takeaway for us is that you should never base your financial well-being on the bureaucratic decisions of a central bank, because they can change the rules of the game just by tweaking a monthly cap. I want you to think about this whole situation through the lens of what I call the circle of competence, because it is the most important concept you will ever learn in investing. Most people look at this data about repo fails and negative rates, and they think they need to be smarter or faster to make money from it. But the truth is, you just need to be disciplined enough to ignore it. I don't know how to trade repo agreements, and I certainly don't know how to predict weekly settlement failures. And frankly, I don't want to know. If you are spending your time worrying about a $30 billion delivery fail, you are missing the forest for the trees. The real money, the kind that lasts, is made by owning wonderful businesses that have a moat around them protecting their profits from competitors, not by betting on the minute-by-minute fluctuations of government debt. When you step outside your circle of competence and try to play a game you don't understand, you are like a man bringing a knife to a gunfight. These traders who fail to deliver are smart people with high IQs, but they got caught in a trap of their own making, simply because they thought they could outsmart the market. So here is my advice to you as we finish up our sodas on this lovely afternoon and watch the world go by. Don't let the noise of the market distract you from the signal of long-term value creation, whether the Fed buys $6 billion or $14 billion next month. It doesn't change the fact that people will still be drinking Coke and eating candy and buying insurance 20 years from now. Those are the things you can bet on with certainty. And those are the things that will let you sleep soundly at night, while the bond traders are sweating bullets over settlement dates. Remember, my friend, that money is a byproduct of doing something well over a long period of time, not a prize you win for guessing the right number on a roulette wheel. Go home, look at your portfolio, and ask yourself if you own businesses or if you just own pieces of paper that you hope to sell to someone else for more money. If you own businesses, you will be fine no matter what the Fed does. But if you are just speculating on paper, then you might end up like those folks who failed to deliver $30 billion of bonds. Keep it simple, keep it honest, and let the miracle of compound interest do the heavy lifting for you.